So yesterday morning, I traveled on a plane from Connecticut down to Washington, D.C. And as we were approaching Washington National Airport, we hit some turbulence. Yesterday was a very windy day in the national capital, and the plane bobbed and weaved as we were approaching our landing. And it reminded me of the presentation today, and that as we experience in the financial markets, there's going to be ups and downs. But the important thing to remember and the purpose behind today's webinar, and I hope will be the main message that you take away from today's presentation, is that there is science and engineering that goes into designing an airplane as well as designing the portfolios that we manage at Hammond Iles Wealth Advisors. I knew sitting in that plane, although it was a little uncomfortable at times with the movement of the plane, that the engineering, studying plane flight for decades, has led to that point where the pilots have been trained to be able to handle those circumstances, and that the plane was designed to withstand the fluctuation of turbulence. The same holds true for investment portfolios based on academic research, that there have been decades of research on how to create portfolios to not only more proactively capture upside market return, but also withstand the downside and fluctuation of the market that is just part of investing. And so today we're going to talk about strategies for navigating unpredictable markets, because the markets are unpredictable. If there's anyone out there saying that they can predict the future of the markets, they're lying to you. It's just a best guess based on their experience or kind of the information that they have at their hands. But the markets are going to fluctuate based on circumstances of everyone participating in the market, which is unpredictable. Now, throughout today's presentation, we will be sharing some opinions, not only of our firm, but sharing slides from a company, Dimensional Fund Advisors, which is a company that has, for many years, been a leading investment firm that provides investments based on academic research. We'll be using some of their slides and charts today. So want to acknowledge them and thank them for providing that information, because we want to boil down providing you today investment principles for navigating volatility. We're seeing a lot of that in the market over the last week, and it's important to understand it and know how your portfolio is designed to navigate through it. So the first thing that I want to point out is that markets have rewarded long-term investors, and it's important that you are a long-term investor, because as we take a look at your money, it's going to need to work hard for you, because your money today will likely not buy as much as it did previously. Just taking a look at 17 cents back in 1920 purchased a quart of milk. In 50 years later, in 1970, that same 17 cents only bought you 2 cups of milk. And as of last year, in 2024, that 17 cents only got you 10 tablespoons of milk. So we need our money to work hard to outpace inflation. And I know certainly that may be a top concern of yours right now with the implementation of tariffs in the United States and what that may impact in prices. And so we want to talk about how do we keep up with that. The important thing to realize is that the stock market is one of the best places to invest for your money to keep up with the financial markets, to kind of lay a foundation to understand the markets. I just wanted to take a brief moment to share about, when we talk about markets, the types of investments that we're talking about. And ideally, I'd like to refer to my daughters as an example of a business. They had Lindsay and Kelsey's luscious lemonade stand. So if we think of them as a company, and they want to grow their business, there are basically two ways that they can get money to grow their business. The first, as we see here on the screen on the left-hand side, is if they issued stock. Basically, an investor, whether that's the bank of dad or someone else, wants to invest in their business. They invest money in exchange for that, they're issued shares of stock. And what that is a share of ownership. So as the company grows or generates profit, as an owner, you're due to receive a share of that profit if they're paying a dividend, or if they're putting those profits back into the company, the growth of the company would in turn help the share price of that stock go up in value, so that you benefit through the appreciation of the stock. Now, on the other side of that, you can generate money for business through issuing bonds. And bonds is basically an IOU where the company is saying, if you loan us money for a period of time, then we will pay you interest over that period. And at the end of the period, we'll pay that principal back to you. So it can be any length of time, and based on the credit quality of the company and the length of time that they're issuing that bond for, will pay a different level of interest. Now, because a bond has a commitment to paying the principal back at the end of that period of time, bonds tend to be more stable in value, whereas stock, there is no guarantee as to the ultimate repayment of your investment. It could go to zero, or it could go up substantially, or anywhere in between. So when we take a look at using stocks and bonds as part of an investment portfolio, it's to capture market return through the growth of companies, not only in the US, but throughout the world. And when we take a look at the need for investing in the markets, it's because, again, we want to grow and outpace inflation. If you had $1 that you had back in 1926, just to keep up with inflation over the last basically 98 years, you would have had to have that dollar grow to $18 in that time frame. Now, if you just invested in United States Treasury bills, which are 1-year bonds issued by the US government, that $1 would have grown to $24. Now, it would have outpaced inflation, but not by very much, would have given you not much of wiggle room there. And certainly if you looked a little bit further out on a longer maturity of government bonds, such as a long-term government bond, you would have had a little bit higher return. But one of the things that you'll point out in that line is you will see ups and downs with long-term bonds, as we have seen over the last few years. And then the top two lines are two areas of the stock market, just showing large company stocks as well as small company stocks. And both of those far exceeded the inflation rate. So one point that I would like you to take away from today's presentation is that it's important for everyone to have some part of their portfolio tied to the financial markets, because we need to grow and outpace inflation. So as we talk about the science, just like the science of the airplane that I flew to Washington, D.C. yesterday, the same holds true for creating a portfolio and the portfolio structure. And so I want to talk a little bit more about the foundations of portfolio structure. Now, the primary driver of creating and building portfolio, there are three primary academic investment principles that it's based on. The first is that the market is efficient, the efficient market hypothesis, that when information is known, the markets will immediately react to it. Certainly on Monday, that was a pure example of how efficient the markets are. There was one message that went out about the potential of tariffs being paused for 90 days. And in a matter of 30 minutes, the markets moved 8% in 30 minutes. That one piece of news moved the markets. Now, the second academic investing principle is the modern portfolio theory that owning a diversified portfolio will help reduce risk over time while increasing the long-term return of a portfolio. But what I want to spend the next few minutes talking about are what originally were the three-factor model from Eugene Fama and Kenneth French. In studying the markets going back to the Great Depression and looking at where market returns came from, they originally started out with three factors and then added to that. And so on the screen here in blue, you'll see four factors. There's actually a fifth, momentum, that we're not including in the portfolio at this point, but is part of the picture. But the majority of market return is covered by these four factors. So first is kind of a no-brainer that, just like the chart that I shared with you previously, the stock market has far exceeded the bond market. And so there is what's called the equity premium, that in it taking on the risk of owning stocks, you're expected to get a higher rate of return over time. It doesn't always happen year over year. There will be years where bonds do better than stocks, but when we look over time, stocks outperform bonds. The second that you may have noticed in that chart is that company size comes into play, in that there is a size premium, that if we look over time, small size companies will outperform large size companies. Again, it's not held true each and every year, but we know that looking over time, that premium will show up and small size companies will outperform large size companies. The third factor is what we call the value premium, or what's mentioned here as relative price. And so when you're looking at the stock market and picking stocks, there are two common ways of investing. The first is what we call the growth method of investing, where when you're looking at a company, you're focused on what does the future growth look like for that company. You're not paying too much attention to the stock price because you know the company hopefully will grow and the stock price will hopefully go up with it in the future. The second way of investing is what we call value investing. Now, value investing is more of a numbers evaluation and calculation. And that value investing takes a look at the value of all of the underlying assets of a company. So the buildings or the assets, machinery, or anything else that the company owns, the value of that company, and how does it compare to the market value of a company. So if you take all of the shares of outstanding stock and multiply it by the share price, you'll get the market value. And when we reach a point where the market value is below the book value or the value of their assets, it's considered a value stock. And so in looking at those two methodologies of investing and evaluating stocks, it has been shown through academic research that investing in value companies can outperform growth in companies over time. Again, it doesn't always show up year after year, but over time, that value premium shows up in portfolios. Now, the fourth factor that has been added in recent years is a focus on profitability. And this, you may too say, this kind of makes a whole lot of common sense, in that companies that have a large amount of profitability versus companies with lower profitability should perform better over time. They have more free cash flow, able to deal with different circumstances in the economy and in the world, as well as being able to handle going back in and growing the company more with those profits. So it's overlaying all of those factors into a portfolio that allows us to tilt the portfolio in a way to capture market returns in a way that can potentially lead to increased rate of return over time. It also, through the diversification of the portfolio, has the ability to potentially reduce the risk within the portfolio as well. Now, the bottom two items that are in green talk about fixed income, or what we call bonds. And there are two main factors that we have to pay close attention to when it comes to bonds and the type of bonds that are in the portfolio. Two of the main factors that we look at for bonds are the term or the length of the bond. So does it mature in 1 year, 5 year, 10 years, or out 30 years in some cases? Also, the credit quality of the company or the US government or any worldwide government that's issuing those bonds. One of the things that I just want to take a moment to share with you is that you can think of investing in bonds as a seesaw or a teeter-totter. If you remember as those childhood days, that if you had a friend that got on the teeter-totter and pushed it way down and then jumped off, you would come plummeting down. Well, unfortunately, the bond market can work in the same manner if you're not paying attention to the term and credit quality of the bonds you're investing in. Because the way that bonds react, not necessarily with the stock market, although there can be some influence of the stock market on the bond market, but the bond market primarily moves relative to interest rates. And so you'll see interest rates on one side of the teeter-totter and the value of bonds on the other side. And what we see is they move inversely. So what we saw in 2022 as interest rates started going up to kind of work against inflation, the value of bonds went down. Now, if you owned long-term bonds, like 30-year bonds that are out at the very end of that teeter-totter, you saw a much sharper drop in value in 2022 than a short-term bond that's closer to the center of the pendulum there that will not have as much fluctuation in value. Now, the same holds true when we see interest rates start to go down, that the value of bonds will go up. And this will be something that we'll be paying attention to here as the Federal Reserve starts to deal with the challenge of how do you manage inflation at potentially the same time that the economy could slow down with the implementation of tariffs. So one of the things when we look at adding bonds to a portfolio as part of our science in maintaining the structure to navigate unpredictable markets is we stay focused on short-term, high credit quality bonds that are closer into the pendulum of our teeter-totter so that when there are changes in interest rates, we're not going to see as much in the way of fluctuation. The purpose of those bonds is to provide stability, and I'll talk a little bit about more about that in just a few minutes. So just taking a look at some of those dimensions of expected returns, taking a look at those factors. On the left-hand side with the blue bar chart, you'll see that we're looking at the size. So in the US, you'll see that looking back over 1928 to 2024, over those last 98 years, small size companies have averaged 11.91% versus large size companies that have averaged 10.15%. The same holds true if we look outside of the United States. Now, the data only goes back to 1970 when international statistics were started to be captured about developed countries outside the US. But the same size premium shows up. Small size companies outperform large size companies. And then also in emerging markets, smaller countries that have emerging economies and stock markets, same holds true there. In the middle, you'll find relative price. So again, talking about value investing versus growth investing, you'll see the green bars outperform the growth investing over time in both the US, internationally, and emerging markets. And then when we add the level of profitability onto it, also those stocks with high profitability, both in the US, developed markets, and emerging markets, have a tendency to outperform over time with that profitability premium. Now, when we take a look at those premiums, as I mentioned earlier, they don't show up all the time. And so there is a probability that they may not show up in a particular year or a period of time. And so these next three slides, I'm just going to share some percentages with you so you get kind of an image and understanding of how frequently these premiums show up. And that's why we implement them as part of your portfolio with Hammond Iles Wealth Advisors. That market value is where markets outbeat T-bills or treasury bills from the US government. You'll see that in looking at any 1 year period of time, there's a 70% chance that the stock market will outperform the bond market. So 7 out of 10 years, typically you're going to see the stock market. And you'll see that hold up true as we talk about performance of the stock market, the ups and downs, and that the stock market is typically up 3 out of 4 years and down 1 out of 4 years. So that holds true with this statistic. But you'll see that as we go further out, 5 years, it goes up to 80%, over 10 years, 86%, and over 15 years, up to 96%. So it's a very solid premium when we look over extended periods of time. When we look at small size companies versus large size companies, again, it's close to a 50-50 shot in a 1 year time frame. 55% of the time, small size companies will outperform large size companies. But again, as we go further out over extended period at a time, that small cap premium shows up. And in over 15 years, almost 80% of the time. The value beating growth a little bit more prominent than the small size premium. Almost 60% of the time in 1 year periods, you'll see it outperform growth. In as short of 5 years, you're up to almost 70%. And again, over 15 years, 86%. And when we take a look at profitability, this is even more present in that 67% of the time in a 1 year period. High profitability firms will outperform low profitability firms. And when we get out to 15 years, it's almost certain, but nothing certain when it comes to the markets. That's why it's unpredictable. But 98% of the time, over 15 years, we'll see high profitability outperform low profitability. So what we see here in the US is that those premiums show up consistently, but we have to be committed to them over the long term to get the benefit of these premiums. And the same holds true when we look at developed countries outside of the US. We'll see that, especially when it comes to high profitability, you'll see 100% opportunity there over 10 or 15 years. And then also looking at emerging markets, you'll see that these premiums again show up very consistently over long-term periods of time. However, if you're focused on short-term, under 5 years, you'll see that it could be at odds. You could have several years where the premiums don't show up and then show up later on, and we'll show a chart on that as well. So it's important that we're committed to these premiums long-term to be able to capture those added benefits. So just to visualize, how do we go about then implementing these premiums in allocating our portfolio? So this chart, I think, does a nice job of showing how they're layered on top of each other to create a diversified portfolio. So if we start on the left with the market premium, and in this initial example here, we're looking at 100% stock market. So that would be an additional layer that gets added on based on your risk tolerance and your preference for managing the volatility in your portfolio. There would be a layer of bonds that gets added to the portfolio, but for this example, we're looking solely at the stock side of a portfolio. So if you're entirely in the market, so you're capturing that market premium. So the next is that we want to add that small cap premium. Now you'll notice that we don't completely throw everything out and only invest in small company stocks. We own both large company stocks, the gray dots in that second square, and then we add kind of the gold or yellow companies that are smaller size companies to the portfolio. Then on top of that, we add the relative price. So looking left to right, with the left side being value investments and the right side being growth investments. Again, just because value performs better over time doesn't mean that we're not going to own growth investments over time. So the portfolio is going to own some of both. And that's going to be both large value stocks and large growth stocks, as well as small value stocks and small growth stocks. So that's all focused on. Now, in addition to that, we've allocated out to those different areas. The fourth premium that we want to overlay on all of that is focusing on profitability. So you'll see that some of the circles in the box on the far right are larger or darker than others. And that's where you're adding a little bit of more of a focus on the profitability of companies that are within the portfolio and lessening those that are less profitable. So we're able to layer all four of those together to create a diversified portfolio based on those academic investing principles. Now, one of the things that is really important as we look at the benefits of diversification is that it's important to be invested not only in the US, but also worldwide. So one of the indices that we commonly look at in building our portfolios is the MSCI World Index. It's looking across all the countries of the world. And I thought it was important to take a look at this, that if we take a look over the last basically 34 years from, I'm sorry, 14 years from 2010 to 2024, the average return of that world index has been just under 10%, about 9.8%. Now, if you excluded the top 10 investments during that 14-year time frame, you could see your portfolio return drop off dramatically. And this is why we don't jump in and out of investments, because if you miss those top investments, it can have a sizable impact on the overall return of your portfolio. And if we miss the top 25 contributors each year, what we find is that the portfolio return is reduced even further. So the idea is to own investments that don't move identically. And we saw that as an example this year in 2025, at the beginning of this year, how international markets took off and far exceeded the return of the US markets. And so many of our portfolios, although the news might have you think that you were negative in your performance, were actually positive because of the diversification that we had. Now, circumstances can change, and we have seen tariff declarations make a change in the world markets, but diversification helps out. Because when we look at stocks in the world, what we find is that the US stock market only makes up 65% of the worldwide stock market. So if you're only investing in the United States, you're only investing in about 2/3 of the stock that's available to invest in. And the challenge is that none of us, again, can predict where in the world is going to be the best place to invest. This chart here gives you an overview looking back over the last 20 years of what the top performing countries were in the developed markets. One of the interesting things looking at this chart is that if you look for the US, which is a light blue, you'll see here in 2014, the US was the top performing country at 12.7% in 2014. However, if you look along that top bar, you don't see the US anywhere at the top over that entire time frame, except for that 1 year. Certainly last year in 2024, it was a runner-up behind Singapore, but nobody are you hearing talking about these countries. I didn't hear anyone breaking out their Italian wine and creating toast in 2023 because Italy was the best performing stock market in the world in 2023. So what this chart points out to is that we can't pick and choose. So we invest around the world in developed markets because we know that, like last year, we had some of our investment portfolio in Singapore and were able to capture some of that return. Now, another way to look at that chart is this chart here. So if you took that developed markets and you converted it into this line chart, what you'll see here is that the gray in the background represents all of the countries from the best performers to the bottom, and everything in between is grayed out. So you can see the differential around the markets around the world, that there are ups and downs, and some are up while others are completely down. And in the middle, you'll see that blue line, which is the USA index. And you'll see that the US has been in the middle. So just like the chart that we were just looking at, where the US was only at the top in 2014, uh, you won't see it at the top of this chart throughout the entire time frame we're looking at. And when we look at time frames like what has been commonly called the lost decade between 2000 and 2010, where the S&P 500 index, which represents 500 of the largest US companies, were basically flat for that 10-year time frame, you'll see that we were at the bottom of that time frame. That time frame where the US markets were basically flat, there were substantial gains that were to be had elsewhere in the international markets. So that is why it's important to not only be diversified in the US using the factor models and the factor premiums, but also that we're invested globally around the world. Now, as I mentioned to you earlier when we were talking about the factors and I was pointing out the teeter-totter of bonds, it's important that you understand that we own bonds as part of the portfolio as a buffer. Although bonds will have an added return and provide dividends to a portfolio, their primary job, the first role that they have in the portfolio, is to help protect value. Now, there are always exceptions to the rule. So you will see here in 2022, where the blue bar represents the Bloomberg Global Aggregate Bond Index, and then the MSCI World Index or worldwide stocks are represented by the gray bar, that in that year, in 2022, when interest rates shot up to help hedge against inflation or bring inflation down, both the bond market and the stock market went down in that year. However, in many years, you'll see that that bond component has been to the positive. In some cases, it may be just slightly positive, but in most cases, it's adding value and protection to the portfolio. And in some cases where the bond stock market is down, you'll see that the blue is holding up and adding positive returns. So based on your level of comfort with risk in your portfolio, we would dial in the amount of bonds to be held as part of your portfolio. And so that's part of the conversation that you have with a financial coach at Hammond Iles. We talk about what is the worst case scenario, not what we're looking to have the best case, to make sure that we achieve what I like to call the swan effect, the ability to sleep well at night. And so one of the ways you can think of your portfolio, I'm kind of on a transportation kick. We were talking about planes, and now I'm going to talk to you about a sailboat. I like to think of a sailboat as a representation of your portfolio. As a child, my dad ordered a instructions from Popular Mechanics magazine, and he and I built together a sailboat that we used when I was younger. And so I got to learn the parts of the boat as we built them. And two of the main ones that I want to focus on for our conversation today are the keel at the bottom of the boat and the sail at the top. So the keel is the board that slides through the boat or attached to the bottom of the boat that goes down into the water that is meant for stability. So that as the sailboat leans from side to side, the keel is underwater to help push against that to maintain the boat upside. And so one of the ways that when you think about your portfolio is think of the keel as your fixed income or bonds in a portfolio. Now, the other aspect of the boat is the sail, which you can think of as equities or stocks. So the sail, you're going to capture the wind to propel the boat forward, and the fixed income or bonds is going to help to slow the boat down and maintain the balance. So if you have a boat that you have a very little keel on the bottom and you have this huge sail at the top, you're going to catch a lot of wind and you're going to go quite quickly. However, you're going to see a lot of swing in that boat because of the sail. Now, for someone on the other end that wants to be more conservative, you could have a huge keel on the bottom of that boat to provide a lot of stability and a much smaller sail that will still propel you, but not cause you a lot of volatility or swinging from side to side. Now it's going to go forward, but it's going to go forward at a much slower pace than a boat with a much larger sail. So as we talk about creating a portfolio for you and the ideal allocation for your investment portfolio, this is where we spend a lot of time up front choosing an allocation that you can commit to for the long term, because this is not something that we want to adjust. Unlike a sailboat where you adjust the sail based on where the wind's prevailing, we want to pick an allocation of your portfolio that we can commit to for the long term so that we can capture those market premiums that have been engineered into your portfolio. So to kind of start to wrap up our conversation, I want to talk a little bit about navigating market volatility. One of the things that it's important to understand is when you're in the middle of a situation, it feels like it's different than everything in the past. And as a result, the markets are going to react in a way that has never been done before. However, when we look back over time, and in this chart looking back since 1970, you'll see all these different concerns along the way. And this is just a small sample of it. We all can remember back on Brexit, how it was determined that when the UK left the European Union, that it was going to destroy global trade and cause a worldwide recession, but that never happened. We were worried about the Y2K scare of computers crashing down, but that didn't happen. We did experience the dot-com crash in 2000 to 2002, and some things out of our control, like the 9/11 terrorist attacks or Hurricanes Katrina and Rita, weighed in on our concerns. And certainly in March of 2020, we dealt with the COVID-19 pandemic. And while talking about that, I want to share a story that will actually come out on Friday as part of our 60-second Financial Friday message. If you're not watching those, it's a 60-second message that we share every Friday on our YouTube channel and on our social media channels. It's a 60-second message, just a quick financial tip or guidance to share with you on that week to help you have a more successful and profitable financial future. And this week, we're talking about a story to make sure that everybody realizes that when you're in the middle of a market downturn, it feels like something has to happen. You need to take action. But when we look back to March of 2020, the beginning of the pandemic, the stock market in the US went down 34% in 33 days. One third of the value ripped away in just over 1 month's time. Now, many people, many investors panicked and headed for the doors and sold their investments. However, if we fast forward and look at how the markets performed after that, not only did the S&P 500 index regain that 34% that it lost, but it ended the year of 2020 up over 16% for the calendar year. So it's important to realize that when we're in the middle of a situation, it can feel like we need to take action, when really what we need to do is stay focused on our investment principles and continue to review and rebalance our portfolios. If anything, it provides an opportunity for us to buy more stock at cheaper values. The other thing, as I mentioned earlier, when we look at the performance of the markets going back over the last 99 years, these are all stacked out on the annual performance of the market index. What we see is that 74%, or the blue boxes, were all positive, ranging anywhere from 0% to 10% up to 50 to 60% in 1 year. On the red side of the chart are the years where the return has been negative, and that was roughly 1/4 of the time, or 25 out of the 99 years. But one of the interesting things, when we're looking at dividing things up by categories, is if you look at that column in the middle of the blue section where the performance of the stock market was up 20 to 30%, there's 24 years out of the last 99. So just as many years as the market was down, the market was up 20 to 30%. So it's important that we take this in mind, that when we do have a year like 2022, where we had a negative year in the market, that really the market trends upward over time, and 3 out of 4 years on average will have positive returns, and in many cases, substantial returns. And it's important because if we try to time the market, you have to be right 2 times, not only the right time to get out, but also the right time to get back in. And that is the unfortunate circumstance that we see many people that jump out of the market, they miss the upside when the market does recover, because it can recover very quickly, just like the trading on Monday, where the markets went up 8% in a matter of 30 minutes. I guarantee you that you didn't have your finger on the button to say buy when it hit the bottom or started that process. And it can shoot up very quickly, and you can miss out on performance. And this chart shows the importance of staying invested. So between 1990 and 2024, a period of 34 years, if we look at the performance of the Standard & Poor's 500 index, if you had invested at the beginning of 1990 and let your money run all the way to 2024, you would have seen your initial investment grow by 10.6% on average per year, and would have ended that time frame at $34,000. I believe that's an initial investment of $10,000. Now, just missing 1 day, just 1 day, brought your average return down almost 0.5%, and your total portfolio would have only grown to just over $30,000. Now, if we look at just missing 5 days, and this is over 34 years, you only missed the 5 best days, your return would have been cut and your portfolio would have dropped down to $21,494. And as you see, as we go down the chart, just missing 15 days, 25 days, 25 days, so less than 1 month out of 34 years. If you missed the best 25 days, your return would have almost been cut in half. Your return would have only been 5.8% over that time frame. So it's important that you stay invested to be able to capture market returns when they do recover. Now, these next two charts I want to share with you because although you may say, well, Greg, we're not at a new market high right now, I always get the question, Greg, we're at an all-time high. Should I be investing? Well, statistically, yes. If we look back from 1926 to 2024, the 1 year period after reaching a new market high, the average return of the Standard and Poor 500 index was a positive 13.7%. And if we look out 3 or 5 years, it still was over a 10% per year return over that time frame. So yes, being at a new market high, it's still a good time to invest. Now, on the other side of that, Greg, we went through a market decline of more than 10%. Should I invest? The market's down. Well, statistically, yes. If we look back from, again, 1926 to 2024, the 1 year after a decline of more than 10%, the average return of the Standard & Poor 500 index was 11.7%. Again, looking out 3 and 5 years, up over 10% over that time frame. So whether the market is reaching a new high or reaching a new low, it can be an opportune time potentially to add money or invest more in a portfolio. And it's one of the reasons why we have a systematic process of rebalancing. So when the markets do hit highs or go up, we do rotate and trim back those that are doing well to those that aren't doing so well to capture potential returns and maintain the level of risk. And the same thing when the market goes down. We'll trim some of the bonds and buy more stock while the market is down to buy stock at a lower level because of this exact chart that we know that over time the market will go back up and will benefit from buying more shares at a lower price. Now, this chart, I think, is very appropriate for what we're experiencing as we talk about unpredictable markets. Just by investing in the stock market, we are going to see fluctuation in volatility. The amazing thing for me when I look at this chart, which it shows the fluctuation each year on a calendar year basis. So the light blue part shows the highest point that the market index reached in that year. And the gray part of the chart and the bottom is the largest intra-year decline. So where it declined. So you'll see that each and every year, no matter the year, it had a period of the year where it was up and it had a period of the year when it was down. Every year is going to have some fluctuation. However, what you'll see is the dot. Pay attention to the dots. The dot is the calendar year return. So just like I talked about the story of looking back at March of 2020, where the market went down 34%, it ended the year up over 16%. So the blue dot represents where the market ended the year. And you'll see that following that chart that we talked about, where 3/4 of the year is positive and 1/4 is negative, you'll see a lot of blue dots above the line here, positive returns, even though sometime during the year the market dipped to being negative and having that gray part of the line. So it's important to understand that volatility in the markets is just part of the process. We're going to see markets go up and down based on a variety of factors, whether it's the economy, tariffs, world conflicts, whatever it may be. There's always going to be something that's going to cause some uncertainty and volatility in the market. Some years will be less volatile, has a smaller line there, and other years will be much wider of a swing. But 3 out of 4 years, statistically, we're up with our blue dot above the line. So it's important to remember the dots, many of them above the line. Also, when we talk about staying invested, this chart takes a look at the performance of the Standard & Poor 500 index going back to 1926, where the market went down by more than 20%. And when it did, you'll see it represented on this chart by the red below the line. So for example, when we look back at 2022, you'll see that 9 months that the market was down 24%. But then the market's recovered, and since then, the 26 months since then, the market is up 70%. And you'll see substantial returns following a 20% or more downturn of the market, whether that's going back to the 1970s. We see these substantial bull runs, as we call it in the market, where the market is trending upward. Now, you'll see on those blue parts of this chart that it's not a smooth ride going straight up. There are still ups and downs along the way, but the general trend is up. And so it's important that when we experience one of these bear markets or a 20% or more downturn in the market, that it doesn't cause us to jump out. Because if we jump out, we're going to miss that trend that follows and has historically followed a market downturn. So it's important that we stay invested, that we follow the academic principles, and that by following those, we're able to capture market returns. And we can create, looking at our sailboat, create a portfolio using short-term, high credit quality bonds to reduce the risk to the downside, while still giving us opportunity to participate and grow to outpace inflation. So I really hope that our conversation today, talking about the investing principles, how a portfolio is created, and how the markets perform over time, and that volatility and the unpredictability of the market is just part of being an investor. But it is one of those things that we need to incur to be able to sustain our way forward. So as I just kind of scroll through some of the descriptions and disclosures of the indices that we used in our charts, I just want to thank you for joining us today. For those of you that are not currently clients of Hammond Iles Wealth Advisors, I just want to take a quick minute to share with you some of the resources and our ability to help you along your journey on investing. One of the things that is unique to Hammond Iles Wealth Advisors is that we do not have a minimum investment amount. We know that everyone starts from zero. And so whether it's you, your children, or grandchildren that are looking to get started on investing for your financial future, we're here to help. And that can all start with a free conversation with a financial coach. We consider ourselves financial coaches as opposed to financial advisors, because in times like this, we are here to be alongside you and coach you through it. You can access and schedule your own free conversation either by scanning the QR code that I have on the screen now, or by going to our website, which is hiwealth.com. As I mentioned, we have no minimum investment amount. We continue to host these online financial power hours. You can find the recordings of all of our power hours, as well as that 60-second Financial Friday message on our YouTube channel. I encourage you to receive the other information that we share by following, connecting, or liking us on social media. And I encourage you to check out the resources on our website. Hammond Iles Wealth Advisors has a resource page, one of which I just want to highlight is our Family Inventory Workbook. One of the reasons why we work with multiple generations of a family is to make sure that wealth passes from generation to generation smoothly and as tax efficiently as we can assist with. And one of the ways of doing that is through organizing your financial information. We can do that not only through our online website, our personal financial portal, but also by downloading your own personal family inventory workbook allows you to gather all your financial information in one place, so that if something were to happen to you, your spouse or family members would be able to pick up where you left off with knowing where everything is and who to contact.